Thanks everybody for joining. My name is Omri Ben David. I'm a partner at Viola Ventures. We have just north of 50 participants. So I guess we're not the only ones excited about embedded fintech. That's the topic for our webinar today. You know, embedded fintech is one of our strongest investment theses at Viola. The idea of offering vertical financial services in sizable industries, whether it's mobility, healthcare, real estate, agriculture, e-commerce, etc., with attractive solutions on one hand for enterprises or brands that want to monetize on their audiences, improve retention, and offer bespoke financial instruments for higher quality of service. And on the other, we have the end customers that want to benefit from flexible solutions, inclusion, transparency, affordable solutions at some point on the other. And in the middle, we see a lot of startups that are going deep on a certain vertical, leveraging proprietary industry data, using AI and machine learning for underwriting and algorithms, risk scoring, engagement tools, and of course, custom UI and UX. Sometimes there's a fourth stakeholder in the mix, an external capital source that basically provides balance sheet capacity to those startups and offloads some of the risk from the startup for attractive financial returns. So what we're looking at basically, it's a win-win-win-win solution. So I guess what's not to love. So we are fortunate to have with us today Ran Makavy from Lyft. He's the EVP of Strategic Initiatives, and I will do a fireside chat with him shortly, followed by two CEOs from our portfolio, EasyKnock in the real estate space and Payzen in the healthcare space. So Ran, hi.
Hey, how's it going?
Good, good. Thanks again for joining. It's a privilege to have you with us. Maybe before we kick off to questions and answers, why don't you just introduce yourself, your role, and kind of maybe the overarching view on embedded fintech in mobility.
Cool. So hi everyone. If you don't know me, my name is Ran Makavy. I was the founder and CEO of Snap2, a company I started in 2006, which I sold to Facebook about 10 years ago. I spent 4 years at Facebook leading growth in emerging markets, and I spent the last 5 years at Lyft. I joined Lyft originally to start the growth team, and over time I ran all of tech, which is all of product design, engineering, data science. I ran almost all of our marketing budget, and in the last couple of years, I was basically leading the rideshare business until a few months ago. Today, I'm working on more internal stuff, and I'm running a small startup inside the company, but that's not super relevant to this call, but the 4 years before are super relevant. So let me give some context about Lyft, and I think Lyft is actually in a set of relatively small group of companies that tend to build a lot of things in-house, and also is capable of building a lot of things in-house. A lot of companies like to build in-house, but that doesn't mean they're able to do that. But that means it's often Lyft is not the typical customer that you can look at and say, if Lyft wants it, that means it scales. I mean, often we are a great customer, but I usually tell people, like, if Lyft is your target customer, you should rethink your market size, because we are in a fairly small set of companies to do that. And I want to give you a bit of context, kind of to understand the scale. I think often people from outside are not very close, don't realize that. All the numbers, anything I'm going to say is public data and is somewhat rough, and it's not company official numbers, just FYI. So in 2019, 30 million people took about 1 billion rides on Lyft and spent $13 billion on our platform. And in the same year, 2 million drivers earn money on our platform. That's 1% of the working population in the US, and they made about $9 billion that year. So if you just think about like, let's take payment processing, just incoming, outgoing, we process over $20 billion a year. And we have about 5,000 employees, 2,000 people on the tech side. So, it's like, it was fairly, large capacity to build stuff. And what that means is like, often when you think about how do companies make decisions, if we can save 1 cent per ride, that would be $10 million a year. That means I can put 20 engineers to save 1 cent. And I mean, I can tell you, we have projects that save 5 cents or 10 cents or 20 cents. So if you think about, payment processing, 10 basis point is $10 to $20 million in savings for us. So, you shouldn't be surprised if our pay team has like 100 people or 200 people. So often it's like engineering team bigger than the companies trying to sell us on some solution. So it doesn't mean we don't buy stuff. We do buy a lot of stuff, but it just kind of give you like, and often you think about, I can charge based on what I'm saving. With Lyft, it's often like we're going to save $500 million. We're not going to pay you that much for it. It's like the company is not worth as much. And we often do that type of thing. So we think quite a lot of what's strategic for us. What is the build versus buy? Build and buy is a big part of kind of the decision process. And I'll just give you one more example, then we kind of jump to Q&A. So I just gave examples of payment processing and like, 1 cent or 10 basis point, but it's actually applied to everything. So Omri just mentioned, like if I can get driver retention up by 1% by giving them a financial product, that by itself is worth maybe tens of millions or maybe $100 million for us. So even at that point in time, it's kind of makes sense to think about, okay, what can we do about it? And often it's like then the trade-off of how much control we have over it and so on. So just want to keep those in mind as like we go through the Q&A, kind of like how we think about this internally.
Perfect. So just to kick it off, you mentioned a couple of financial services, but how do you pick and choose which financial services you're going to offer, let's say to your drivers community and maybe even to your end customers community at some point, and how do you roll these out?
Yeah, so it's actually driver and rider is almost like completely separate businesses. I kind of think it's like if you had to imagine the future, an abstract future version of like we have a rider app that should be a teleportation at some point. I mean, you don't actually care about the ride; you just want to go from A to B. And the driver app, in many ways, it's a money-making machine. I actually don't care that I'm moving people around. I want to press the button and start earning money. Right? So it's like there was a day where the apps look very similar. One looks like how to get a ride from A to B, and the other one is how to give a ride from A to B. But over time, these things have evolved quite a lot to kind of fit what the need is. So on the driver side, a lot of what we do is just like attending what is the needs of the driver. So it's like one example is that drivers want to get paid early. So this was like already maybe 4 years ago or something. We came up with this idea of express pay, which basically the drivers, we used to pay weekly. It was kind of like a job. You drive for a week. At the end of the week, every week you get your earnings. We added this feature where drivers can pay, I think, 25 cents. They press the button on the app and it just like gives them whatever money is in their account. Pretty quickly, over half the drivers and half the money in the system go through this express pay. Like drivers don't want to wait for the end of the week. So this was about 4 years ago. I think somewhere around last year, we actually came about it and say, okay, can we make this even better? And this was a place where we ended up with a partnership with a bank account and a debit card that basically you never have to press any button. And you literally, the second you drop a passenger off, you can swipe your debit card and the money is there. Like it's basically like a zero time earning from earning to spending in like zero time. And drivers love those things. So a lot of when we think about priorities, we think about one is like, how do we make drivers' life easier? How do we address the problems they have, not the problems that we have? And does it create any sort of more attachment to the platform? So, now there's a benefit that's if you drive for Lyft and you have the Lyft debit card, then, you don't need to think about you ride, you stop, you want to get food. you have the money in your account. So it's like kind of on the driver side. On the rider side, it's like somewhat similar, but obviously the rider's needs are quite different. It's also not realistic to expect. Actually, both the riders and the driver side, it's not as realistic to expect like 100% like loyalty. The reality is like, if you could make more money by working at 2 jobs, you'll do it. And if you could get somewhere more easily by having, 2 products to get you there, you will do it. So it's really about like either reducing friction or about like enabling more use cases or about creating loyalty. So we kind of put those 3 buckets, and it's a fairly simple kind of like ROI and sort of estimation. So, on the feature side, it could be, how do you split pay? Can I pay with like PayPal, or like we have like stored balance, products, gift cards, a bunch of stuff like that. So that's like different features to make it like easier. I mean, on the loyalty side, we have quite a lot of partnerships with credit cards providers that you can like link your account and get points. I think Lyft is one of the only platform you can actually get multiple credit card points on the same transaction, because you can link multiple accounts to the same one. And then we have our own membership program and subscription program, which is mostly the core built in-house, but with lots of partnerships to go to loyalty. So I think your question you ask is actually a really tough one, because there's so many things you can work on, and like a lot of them are sort of really complicated. I'll give you like an example of something we decided not to do for there's like different point systems that you can use subway points to pay for a Lyft ride. You can like connect the company that accept those points. So it's just like the options are kind of almost infinite. And so we also try to be picky and do something you can do really, really well and be differentiated, not something that's just easy to copy that everyone else will have as well.
But one of the questions then, of course, you articulated the benefit for the drivers and the riders, but Lyft is a big organization. So what would it take to actually move the needle from for Lyft, right? From both operating perspective, you mentioned reduced churn or more loyalty, that's great, but also from a financial standpoint, right? It needs to be, you become a fintech within a large organization that its core business is, ride sharing, basically. How do we think about, the quantum that you need to get to actually make it a business within Lyft?
Yeah, so the start of the team was pretty simple, which was around cost cutting. So it's always easy to justify cost cutting. And so, the first 2 places are payment processing. So, we started with Stripe like everyone else. I think we became the biggest customer of Stripe in the world. And then we, started thinking about what do you do next. So that was easy to justify. You have multiple payment processing routers, stuff like that. Then you have fraud and abuse and failed charges, all the stuff, which is like, pretty common. So we build this team. But by that point in time, you already have like a pretty sizable team with the platform. And then you get to the point in which you mentioned, like, how do you justify actually building a service? And for example, like Uber launched consumer credit cards, and we decided not to launch a consumer credit card. Like, we didn't think that's like as much value. For example, the team couldn't put like the RI Peach out there. We decided to focus on the driver side. We felt like there's a lot more upside there. But I think it's a mobility or transportation in general it's a low margin business, and it will be a low margin business like forever. And if anything, it's just going to get cheaper, because still, ride sharing is still a luxury product. Many people cannot afford it. So for many, many years, I think cost was a big issue, and cost will be a big issue. But I think over time, there's the complexity that we see internally is also complexity that users are seeing externally. There's so many products kind of to use. And so we want to simplify that. So, if like 3 years ago, we had like our own split pay, you take a ride with someone, you want to split the pay, we had our own product. like last year, we actually killed the product and we just launched a Venmo integration. That's what the riders want. Like, that's what we're going to do. Right. It's like, so we're also we're not trying to like fight it. We try to like simplify it for the consumer as much as we can.
Interesting. Before I jump to the next question, I just want to remind our audience, we actually crossed 100. If you have any questions, please feel free either to Ron or Jared and Itzik down the road, just to put them in the Q&A, and we'll try to weave them in as we go. Ron, kind of switching gears. So you mentioned a couple of things. One is that Lyft loves to develop things in-house, right? And you've done, if I'm not mistaken, the entire financial stack in-house. Uber announced, a partnership with Green Dot, or basically went on the banking as a service, kind of the BaaS platform, which is interesting. So I guess a two-part question is, A, why? Why do it in-house and go through the entire, journey to make it happen and maybe not benefit from the same flexibility as some of the other BaaS providers? And B, is would you advise entrepreneurs on this call if they want to do more business with, Lyft or the Lyft alike, with their startup to actually offer those types of vertically integrated fintech solutions?
Yeah. So I think I'll start from the second question. I mean, generally to think about like how to build a product that works well for Lyft, it needs to be a product that's not just user friendly, it needs to be developer friendly. And that's because like Lyft would always want to customize something. So even like, even let's say I'll pick on marketing for example. Even though we build all of our marketing stack, we still use some third-party marketing tools, but we try to use the ones that also drop their data into a database and we can build on top of at the same time, like let's say in parallel. So we kind of get both of those worlds. For the financial stack, so if you think about, let's say like fraud, then because we have such a unique kind of like fraud problems, and I'm not sure as a company will like trust someone to like hand over our fraud problems, but we're definitely not good at every piece of it. So there's could be from small things that we'll just buy. I don't know. We need to know how long since an email address was created. I mean, we don't know how to do it. We don't need to know how to do it. We can just go and buy it from someone, and we might buy more sophisticated things. So that's like a small one. Like a big one is often there's not just a tech, there's also like regulations and like there's a lot of like, especially in financial space, there's a lot of things you need to like set up other than the tech. So for kind of full banking, so we give free bank accounts for drivers right now, and there's even you can go to the App Store and look for Lyft Direct. There's an app that lets you manage your bank account. I mean, this app was actually built by Payfair, so we didn't build the whole like banking app ourselves, and we do use partners for those things. So so it kind of depends like on the regulatory side. If it's pure tech or it's like a little bit of data, we basically want to see as developer friendly offering as possible, so we can customize and sort of integrate.
Great. So basically a tip to entrepreneurs is to make it customizable and friendly to developers, and also obviously externally to the end customers. And I think the BaaS platforms they're supposed to provide the linkage to the regulatory framework, right? The licensing, et cetera, that kind of is supposed or intend to speed up, I guess, the integration process. Yeah, go ahead. You want to say something?
Yeah. Yeah, no, and there's definitely things. There's potentially things maybe we've done that we shouldn't have. I'm not sure yet. It's hard to know what they are when you start. But then there's definitely things that seems easy from like a technical point of view, but might be difficult on once you put the regulatory. So even like stored credit, which doesn't sound like if this was a computer science 101 project, it doesn't sound hard to like code it, but it gets like really complicated once you add all the pieces. And we've had actually for a number of years we had we had coupons that expire. So we had like, let's say our gift card product was pretty broken because gift cards were coupons, and so gift cards would expire, which they're not supposed to expire, but that's because we didn't have a stored value product. So there's probably let's say 3 years ago, there's probably a place where if a company came with like a very simple to use and integrate stored value product, we would have used it at the time. Sometimes it's a little bit timing. Maybe the product was not mature enough. We ended up to the in-house route, and once you have it, you kind of maintain it. So I think the other part is like, which is tricky a bit with early stage startup, is kind of how mature is your product. We don't always want to put like, okay, here's a 30 million users on, you know, like a small company, and like figure out this bank account part was quite difficult. So, I mean, we spent a very, very long time to find the right partner until we got confident that, you know, who we're working with.
So I guess moving on, curious to your thoughts. Fast forward 5 years. If I'm a Lyft driver, I have my checking account with Lyft, but I also have a checking account with, I'm making it up, Bank of America, and I have a checking account with one of the neo challenger banks, and AT&T is offering me a checking account as part of the, you know, the loyalty program to my telco provider, etc. You get the drift, right? I'm going to have 10 checking accounts, a certain fatigue, and definitely not enough lifetime value for you as Lyft or anybody else, right? Because it's going to be spread thin across all of them. Is that where we are facing in 5-10 years, or what's your view?
Yeah, it's a good question. I think it's like, I'll tell you where I want us to get to, which hopefully there's going to be a startup that will take us there, or a few startups that will take us there. But it's not easy, because like there are a lot of players in the industry with like a conflict of interest of where this is heading, right? So I mean, ideally, yeah, I live in when I was in Israel, I had 1 credit card. I'm in the US now, I have 10. Like, I don't want to have 10 credit cards, but it's like, I mean, the benefit that each provider gives me is in some cases more than like the hassle of having more than one. I'm sure the same for the drivers. They don't want to have multiple bank accounts. There's like no reason for them to have that. Definitely not more than 2 or whatever, some small number. I think the question is, will even like Lyft, let's say a startup comes out with the best bank account, and Lyft can integrate with this bank account, right? The question would be, again, like a trade-off. Okay, what are we gaining and what are we losing by integrating it? And then on the flip side, we think about, okay, there's X amount of people in the US that earn like 90+% of their money on our platform. So if we only allow them to use our bank account, they will use our bank account, right? Because it's like, there's no, so I think that becomes like the trade-off for the driver first, and then for Lyft second. I think if a startup or a company managed to create this like, let's say bank account or credit card or whatever the service is, that's like good enough for the user, so they get enough traction, so they get enough leverage on the platform side, which is really hard, then I think there's a chance that things will align. And I think the same is like, if you look on I mean, there are a lot of things kind of on the web that are starting to consolidate, whether you want it or not. I don't know how many sites you can log in with your Google account or whatever that is. Or actually, I don't know if anyone, Okta is not exactly fintech, but you know, whoever's going to build the Okta for consumers and not for businesses. So I think there is a good opportunity to start consolidating, but it's going to be very tough. I don't know if 5 to 10 years is maybe more 10 years to get there.
There's a question from the audience. I don't know if you can address it or if it's proprietary, but basically asking what percentage of the drivers actually using this checking account, and is it free to your drivers to use it?
Yeah. So yeah, I can give you the exact number, but I can tell you on the, you asked earlier, is like, what is the threshold to make it meaningful? For Lyft, this is like 10x past the meaningful threshold. It's very successful. And we don't charge anything for, so if you use our debit card and our bank account, there's like 0 transaction fees on everything. Yeah, you can, the payout is automatic. You actually don't even initiate the payout. It's always automatic. So we can't charge you fees on something you haven't even like executed. And actually more interesting on this one, it's one of the only debit cards that have a reward and cashback program. Normally they only for credit cards. And it has like meaningful discount, like we give 4% discount on food and I think 1% on gas and a bunch of stuff. So it's like, it's kind of like the combination of a
Everything you need.
reward earning bank account. Yeah.
Exactly. Great. We have time for about one more question. So maybe if you can touch on the tech, kind of the IP or the tech aspects of the solutions. What is the role of AI and machine learning? How do you handle fraud, disputes, things of that nature? Maybe for for the audience and just so we understand the kind of the depth of the technology there.
Yeah. So this is like actually I'll tell you actually something interesting which. I was in one of the Icon events, I can't remember, 4 years ago or something like that. And there's some Israeli company, I can't remember, that's like was selling like an ML platform or AI platform. And at the time I sort of told them, it's like, hey, we're building our own ML platform. And the person told me, well, good luck, call me in a year when you fail and then you can use our product. And I would say it was interesting. Think about it in hindsight. I think in hindsight, one, we definitely have the people and the experience to build our own sort of ML AI platform. But it doesn't necessarily mean that we should build everything in-house. We bought a company that's like ex-Google that's built like an AI platform that was already working. We hired like a bunch of people with tons of experience that have built those platforms before. So today, technically, we run almost everything is running on our own internal platforms that we have built sort of over the years for anything from like fraud to like insurance and telematics to lifetime value calculations to fail charge or predictions and so on. But we are actually starting to think through should we roll back to some kind of like common platforms, and a lot of it has to do with maturity. So it could be when we started 3 years ago, I don't know, like SageMaker wasn't there, or like whatever, some other platform wasn't there, and it made a lot of sense to build. And today, I think a lot of things make less and less sense to build. This is on the ML AI platform. I think on top of it, it's like, for example, if you think about fraud, I think it still makes sense for us to build our own platform, and probably will continue to make sense to do it. I'll just give you maybe one example, sort of to finish up like the fraud example of like how unique that is. There's a team in China. I have no idea how many people they have, but it's probably bigger than it's a mid-sized company. They have a tool that automatically creates Uber and Lyft fake accounts. It set up those fake accounts with stolen credit cards. And then it has like a service that runs on top of WeChat where you can order Lyft and Uber rides. You pay with Alipay to that company. It's 50% discount from Lyft and Uber. And then they use a fake account with a stolen credit card on Lyft and Uber to send you a car. They use the share my location feature to send through WeChat where the car is so you can get picked up. And you can guess what happened next. Like you go into the car, you take a ride, and like we get chargebacks and never get paid.
Yeah.
That team, I mean, I don't know exactly what you do, but they have an AI and ML platform on their side to just do that because they and they're so sophisticated. And I mean, we've done a good job sort of fighting them, but you can think of, there's no way that we had like a generic fraud platform that would like handle it. And if it was small startup, there's no way the startup would just stop doing what they're doing for 6 months and spend 100% of their time, solving this problem for us. So, so this is why I can probably talk for an hour on like the 100 craziest like hacks and abuse. And so this is like, I think it makes a lot of sense for us to control sort of like all the flows, the UX, the checkpoints, all the stuff. But at the same time, we could buy things like, I don't know, mobile touchscreen fingerprinting technology, whatever. There's like a million things like in the space that you can think of that we can add to a solution. but I feel like in many of those cases, we need to own like sort of those core platforms.
Great. I'm gonna use 20 more seconds for a last question because it's in the Q&A and it's a repeated question. Just if you can answer quickly, do you guys expect to make money out of the checking account and the debit card, etc., or is it kind of on a P&L by itself? It's a losing money proposition because you're getting the brand loyalty and the retention and everything else you discussed. So is this like a P&L that you're supposed to make money on or not, from a business model perspective?
Yeah, so it's definitely let's say this one. We definitely don't want to lose money on it,
Yeah.
and ideally want to make money on it. There's two things we look at. One is like ideally we want cost to be zero or no cost, but on top of it, we need to make sure that the increase in retention, the ROI on the engineering effort is like well covered by the increase in retention. The question about debit card is really, to make it simple for you, whether we lose money or not is really about like how much do people use the debit card not on Lyft and not on the highest like discount and cashback rewards, right? The more you use it for the low cashback or 1 or 0% return, we get money from it. So, and that could cover. So you can think of things like if we make the product really useful for family, so it's not just a driver, but the partner of the driver is using it. It's more like most likely the partner would be a profit center that covers for it.
Ron, thank you very, very much. It was super interesting, and of course, we all appreciate your time and insight. So thank you.